Do I actually need 20% down to buy a house?
It's a myth. Yep.
What credit score do you actually need?
Oh, that's a great question.
How much money would leave my bank account if I were to buy a home? So you have the down payment, and then what else? What is PMI? Should I buy now, or should I wait for the rates to drop? Ken, thank you so much for sitting down with me. I really appreciate your time.
Absolutely.
So for the people that are watching right now, can you just give us like a backstory of what is your job? How long have you been in it? Yeah, just a little story about how you got into it.
I got into the business meeting somebody at jury duty.
Okay.
I have a finance major, and I was in the restaurant business back then. And I knew being in the restaurant business and having a family didn't coincide. So at jury duty, I met somebody in the mortgage world. They said, if you could put food and drink in people's mouths and keep them happy, you'd be a great person in the mortgage world.
Nice.
So I quit my restaurant job and got into the mortgage business.
Wow.
Living in Capel, fastest growing city back in the 90s. So I've been in the business for about 30 years now.
Wow. Okay.
A couple agents gave me an opportunity, and the rest is history.
Wow.
I actually took my son on sales calls with me when he was born because we didn't afford a babysitter.
Okay.
Yeah.
So you would how old was your son whenever you went?
He was a little bit over a year, a little bit less than a year. He's still in his carrier.
Okay. So you would walk in agents' offices with your baby son. Okay, cool.
Back in the day, nobody worked out of their house.
Okay.
They worked at offices. So I would show up at offices, I'd have them, and all the agents would want to visit with my son and hold him and never talk mortgages.
Okay. Just look at the baby.
Look at the baby,
Yeah.
and here I am 30 years later, all good.
Awesome. So you've been a lender in the Coppell area for over 30 years,
Yes.
is what you're saying?
Dallas, Fort Worth, yeah.
If you could put a number to it, how many first-time buyers do you think that you have helped actually buy a house?
More in the past,
Okay.
because Coppell was younger, or the Dallas-Fort Worth area was younger.
Yeah. Over 100?
Thousands.
Over 1,000?
Probably, in my 30-year career, for sure.
Okay, so you've helped over 1,000 first-time buyers buy homes in and around the DFW, specifically Coppell local area. That is wild. Thank you so much for taking some time to talk with me about some of these questions. And we just wanted to put together some questions that, for a first-time home buyer that doesn't know where to start, just to get an idea of how to be thinking about this process, specifically through the mind of the financing component, through someone of your vast experience. So if you're okay, I'm just going to dive right into these questions.
Let's go.
Awesome.
Let's go.
All right, Kent. 20%. Is that thing real? How much do I actually need for a down payment? Do I actually need 20% down to buy a house?
Ryan, great question. Absolutely not.
Okay.
It's a myth.
Okay.
The majority of my clients, first-time home buyers or even multiple-time home buyers, don't do 20%.
Okay.
We can do as little as 3% for conventional financing. VA, if you're a veteran of the United States, 0% zero down. And FHA is 3.5% down. We also have a program for a community enrichment, community enhancement program, which is a conventional FHA loan, which is 0 down also. So you can get into your house for relatively nothing, so to speak.
Okay, so just to hear what I'm saying, you actually don't need 20% down to buy a house.
Absolutely not.
And I think before this, we were also talking, you have some specific programs that can allow first-time buyers to buy homes for 0% down?
Correct.
Okay, can you say a little bit more about what that looks like and how that's possible?
So VA is the most popular, obviously, and there's a lot of veterans in the United States now. So 0 down. We also have a program that we have at the bank to help neighborhoods have sales or enhance the neighborhoods, bringing in people who don't have a lot of money, who want to be homeowners, and we've created a program that is 0 down.
Cool.
It's specific to certain neighborhoods and counties, so it's not for everybody. It's not every place.
Okay.
There are a couple pockets in Coppell, very a more affluent area, so to speak, that have this program available to them. A lot in Carrollton, the Denton area. So
you're saying that there are areas in and around DFW, even in Coppell and some other areas like that, where somebody could actually buy a home with 0% down.
That's correct.
That's so interesting.
Yeah.
Okay, well, so we've cleared it up.
Yeah.
Myth busted.
Myth
you do
busted.
not need 20% down to buy a house.
That's correct.
Okay, so how about credit score? What credit score do you actually need to buy a home? Is there like a minimum that you need?
There is, depending on the program.
Okay.
So conventional is 620.
Okay.
So that's 3% down, 5%, 20%, whatever, 620. FHA is 580. I've seen as low as 560, depending on the credit profile. VA is in the high fives, 560s, 580s. And that special program that we have in the community, we can go as low as 500.
Okay. Okay, so you can, so for someone that is under 500, if they want to buy a home, then maybe they would have to go to just some credit repair type work, or is like 500 the absolute minimum that you need, depending on the program?
They need to have the minimum requirements, but if they have lower credit scores, which affects loan programs, loan interest rates, et cetera, we have a relationship with our credit agency where I can run scenarios and say, if you pay this off, if you do this, you can increase your scores by X, Y, Z to be able to qualify for a home. So I was working with a young couple 18 months ago. They had 480 scores, low 500s. They wanted to buy a certain house or houses in a different neighborhood. We went through that program. I put them on a realistic financial plan to pay down, open credit cards, to do what the program tells you to do. And we just closed on them in March.
Oh, really? Okay.
14 months after they visited with me, and we put a realistic financial plan together for them, they were able to buy their first house.
Awesome. And they came to you with a credit score below 500?
Correct.
Okay, so it took them roughly about a year or so to get that in order to be able to buy a home.
Correct.
So very possible, basically. So what I'm hearing is that if you're under a credit score of 500 or so, you're within about a year of being able to actually be approved to purchase a home?
Potentially, yeah.
Okay,
Depends
potentially
on the
about
credit
a year.
profile, yeah.
Okay,
and then we also do that program because on conventional loans, interest rates are based on loan amounts, loan to values, and credit scores. So if a credit score is 680 or 700, you might have a hit to your interest rate compared to if you're at 780. So we can take a look at it and saying, hey, if you do this over the next month or so, we can get you a better credit score, gives you a better interest rate. So it doesn't have to be just for a first-time home buyer at less than 500 or 550 to get it up. It can be for anybody.
Oh, okay.
And it's free.
Great.
It's
Wait, free?
Free, my knowledge and my program for them.
Okay. Oh, great. Awesome.
They have to have the money to do the financial plan.
I was like, you can buy a home for free. That would be, Call Kent right now.
Yeah.
That would be awesome. Yeah. Well, cool. That makes total sense. Moving on here, what, if any, do you find is like the single biggest mistake that first-time buyers make before even interacting with a lender?
So there's not one. I would say there's a couple. One would be buying a car. Depends on how you finance it. One would be opening and closing credit cards. Closing credit cards doesn't necessarily give you a better credit score and ability to buy a home. It can actually hurt you. Opening credit can hurt you. Changing your job. One specific thing that I had, the first couple were obvious. Credit cards.
Sure. Basically taking out more loans.
More loans or closing out credit cards. Closing down brings your credit scores down, which could eliminate you from a loan program.
Okay.
One I had about 2 or 3 years ago was a surgeon over in Fort Worth. He was working, doing surgeries at a hospital. He changed his employment status from a W-2 salary employee to self-employed 1099.
Okay.
Right before he wanted to buy a house. And when you go self-employed, you need 1 year of history of being self-employed. We need to take a look at tax returns. So him and his wife and family couldn't buy a house for 12 months. So
just because of that one
Just
move.
because of that one change. He was still making hundreds of thousands of dollars, but he couldn't buy a house because he couldn't qualify because of his employment status from being a salaried employee to self-employed.
Wow.
Yeah.
That's so. How did he receive that? Was that like, could he go back to W-2, or just because he went to 1099? Now that you've seen that, you have to wait a year.
He could have gone back to W-2, but he didn't want to. Okay. Based on their family, based on his employment, based on his relationship with the hospital as a surgeon, he goes, we'll wait a year.
Okay.
And then they filed their tax return. I did their loan, and we closed successfully 12 months after he changed. Yeah.
What about someone that is a W-2 and a 1099? Like, can that person do they have to wait a year if they want to use the 1099 part of their income?
So 1099 or self-employed income.
I think I mean more so like their salary plus commission.
Yeah. Salary plus commission, we take the salary we'll use all day long. Commissions we're going to average over a history. So if they've only been doing it for a couple months, we may not use their commissions. If they've been doing it for a long period of time, we do use their commissions. Sometimes I don't need their commissions, so I don't get involved in that. If they go self-employed, and because some people they do side hustles.
Sure.
And they're self-employed, they file a Schedule C. In the mortgage world, income isn't calculated for a self-employed person until they file a tax return. It's not based on what they say they made. It's not based on anything like that. They have to have filed a tax return in order to look at that. Typically, depending on how long they've been in the business, we look at 2 to 3 year average or 1 to 2 year average, depending on how long they've been in the business.
Okay.
So we can mix and match, or we throw out one because we don't need it.
Okay.
But we'll always use the W-2 salary job.
Okay, so you can always use a W-2, but if someone has commission on top of that, you're going to need at least a year or two, and then you average, because it can be really not stable.
Correct. We look at history, and we look at continuation of the income. So what job is he in? Has he earned commissions? Will he continue to earn commissions?
Okay.
There's no guarantees.
Sure.
So in the industry, we have history of commission people, ups and downs, you and me.
Right. I know.
We both ride the roller coaster as commissioned employees. So we take a look at an average.
Okay.
And it just depends on their job and how long they've been doing it, is how nitpicky we get. What the loan to value is, what the loan amount is, you know, what their credit scores are. There's factors, compensating factors of how we'll let things happen.
That makes sense.
Yeah.
Cool. Another question here is some terms that I know first-time buyers will hear are pre-approved and pre-qualified. Can you help just explain the difference so that we can just get a better clarity of what those really mean?
Absolutely. Those two terms are very confusing to a lot of people in this business. It's like the telephone game.
Okay.
I tell you a secret, you tell somebody a secret, you tell somebody, and by the time it gets back to me, it's not even close.
Okay, right.
So over the history of the pre-approval and pre-qualification and approval process in the industry, it's changed depending on who you talk to.
Okay.
A pre-qualification back in the day, and probably currently today, which I really don't like to do pre-qualifications, is a conversation with my client. How much do you make? What are your debts? How's your credit? That's basically the conversation. And here's your income, here's your debts. You're pre-qualified for this loan amount.
Sure.
Means really nothing, except for me, I know what I'm doing, so it means something.
You could translate that into
But if the client goes, I make $100,000 a year, but I don't know that he's self-employed for 6 months, well, then the pre-qualification means nothing, right? So a pre-approval is without a doubt the way to go. Pre-qualification, I would never suggest that. In a general conversation over a phone, and you could do and say, hey, your buying power is X, Y, Z. But a pre-approval is, I do a soft credit pull. We verify documents if necessary, what their job is, what their assets are, and everything like that. They actually do a loan application online, which takes about 10 to 12 minutes if you know your stuff, name, social security number, address. And I can then do a soft credit pull. Doesn't cost you anything. It doesn't hit your credit, doesn't reduce your credit scores. It doesn't affect any buying power later on. And then I'm able to run it through automated underwriting in our system and have a loan approval, pre-approval, should I say.
Okay. So
and then I may verify documents, I may not, but then we're all very confident that this person is a real deal, a real buyer. They're pre-approved. A letter means something at that point for the sellers and the listing agents and yourself as a working with buyers and stuff like that. I like to take it one step farther in getting approval.
Okay.
So I get their documentation.
Okay.
We submit it to, so I do the soft credit pull. We get their documentation, W-2s, paycheck stubs, bank statements, tax returns if I need them, if they're self-employed, whatever I need. And we actually submit it to the underwriter in Plano. That's where we're located.
Okay.
We actually underwrite the file like they're really buying a house, because they are.
Yeah, sure.
Loans approved. All we need is a contract, an appraisal, and title work. No stress. It's all eliminated. We can do an approval letter for you and your client, which gives you and the client more aggressive offer with 0%, with 0 days financing on the contract, so you don't have to wait for approval. We've also eliminated 5 to 6, 7 days of disclosures and underwriting, so now you can be more aggressive on your closing time frames. Instead of 3 to 4 weeks, we can do a little bit quicker, reducing stress, and so you can then put in a contract that's a little bit more aggressive.
A little more aggressive.
In this competitive market.
Yeah, because you've already done the due diligence behind the scenes.
Done the due diligence, so everybone's...
Yeah, everyone's ready to go.
Yeah.
So what I'm hearing is that a pre-qual is the verbal, here's how much I make, here's like, and then it would be a lender saying, if that is true, therefore this is that.
Correct.
So it doesn't really, there's no stamp of like approval really on a pre-qual. It's all just fairy dust kind
Correct.
of. Okay.
Good analogy.
But a pre-approval is, here is actually my stubs. Here, like, let me give you some data to back up what I've just told you.
Correct.
And then you do a soft credit pull, and you can say, okay, that is true.
Yeah.
Therefore, my stamp of approval is, I've seen it, therefore you could afford to buy a home worth X.
Correct.
But you're saying what you guys do that's different is that you go beyond the regular pre-approval and y'all also begin to underwrite the deal, which is like the double stamp of approval. So that way, whenever that person goes to actually buy a home, they know that they can afford it. There's no waiting. It's like it's already had all the people on your team look at it and it's all given the thumbs up.
That's correct.
Okay.
That's correct.
Cool.
Yeah.
Yeah, because when you said the 0-day financing, for those that don't know what that is, so normally in a contract, there's a certain number of days that like a first-time buyer will have to officially get the underwriting from the loan.
Correct.
Typically it's like what, 10 to 21 days or something like that. But with you're saying that that person doesn't even need any additional time because when they write the offer, they can buy that house.
Correct.
With confidence.
Correct.
Cool. And that's so interesting that not every, I guess, lender can offer that same level of security because they aren't going to do that additional step, right?
I would think that most lenders can do it.
Okay.
They just don't.
Okay.
For whatever reason.
Sure.
I like to take it as far as I can. Helps you out as a realtor.
Yeah.
To make an ironclad deal, and you get an approval letter rather than a pre-approval letter. Again, it makes the listing agent and the sellers feel more warm and fuzzy.
The approval letter and not the pre-approval.
Correct.
Like pre-cal and calc. It's like the real thing.
Correct.
Awesome.
Yeah.
Well, thanks for that clarity, Ken.
Yeah, sure.
So we'll move on to specifically more about the money. So I know another question that people might have is, so let's break down actually how much money would leave my bank account if I were to buy a home. So you have the down payment, and then what else?
Okay. You have closing costs.
Okay.
Closing costs are third-party services, appraisal, credit report, tax service fee, title company fees. Those are necessary evils to get a loan. If you're paying cash, you don't pay a lot of those. But if you're getting a loan, you're paying the third parties. So whatever they charge us, we charge them. And then you're going to have a 1-year homeowner's insurance policy you're going to have to pay at closing. So there's closing costs and then there's prepaid items. Prepaid items would be 1-year homeowner's insurance policy, setting up your escrow account, 3 months worth of insurance, 3 months worth of taxes, whatever the actuals are, we'll look them up. Taxes are online, insurance, you get your own quote.
Okay.
So you put all that together, so you have the down payment plus closing costs and prepaids, and that's what you'd have to get into the house with.
Okay.
On a $400,000 home, we'll use that for an example, is about $12,800, $13,000 in addition to your down payment.
Okay, so that's about 3-ish% of the sales price, give or take, on top of the down payment.
And then depending on how the contract is written, what does the seller pay? Do the seller pay the title policy? Does the seller pay anything else? So that's a different conversation that we can talk about in a little bit also.
But maybe like a fair, like if I'm thinking about buying a home in the next 90 days and I want to know, okay, before I talk to a lender, like how much needs to come out of my bank account? Like maybe a fair-ish estimate that's conservative could be something like down payment, so 3%, 3.5%, whatever loan program you go with, plus maybe an additional $12,000 bucks Cool. For right around the average home, 400,000-ish bucks or so.
Yeah.
Okay,
yeah.
cool.
So let me just tell you an example here.
Yeah.
I just closed one last week.
Okay, great.
$315,000 sale price. So we're bringing it down from the 400. $315,000.
Okay.
They put 3% down.
Okay.
Down payment, closing costs, prepaids, and the seller was paying $7,000 of that.
Oh, okay.
So they walked in for $14,000 total,
including their down payment,
including everything, on a $315,000 home,
wow.
which is about 4.4% all in from the sale price.
But that was able to be possible because the seller paid a variety of their own closing costs?
Correct.
Okay.
Correct.
Interesting. So you had clients that bought a home in the
last
week
yep.
that bought a home, everything out of pocket for right around $14,000.
Yep. $315,000 sale price.
Okay. Wow.
Yeah.
Wow. How about that?
Yeah.
Good to know. Cool.
Yeah.
So that kind of leads me into like the next question regarding affordability. So, because we've kind of broken down how much actually like leaves your bank account whenever you buy a home, but let's talk about the monthly. So like we talked a little bit earlier about you had the pre-qual versus the pre-approval versus the approval, but what actually do you look at? Like when you're doing the approval, like what is the difference between what someone thinks that they can afford versus like what they actually can afford?
Sure. So when your clients call me or anybody calls me, I ask a lot of questions. The first question I'm asked is, what's your interest rate?
Okay.
Interest rate is a necessary thing to have in a mortgage and everything like that. But I ask a lot of questions. What is your budget? What is your desired monthly payment? How much cash do we have to work with? Doesn't mean we're going to spend it, but how much do you have available to you? What area are you looking in? Because taxes and insurance is different depending on the county and the city that you're in and everything like that.
Okay.
Income is very, very important when calculating what they can afford. And then their debts. So the pre-qualification questions, right?
Yeah.
And then I work the numbers up, and based on what they have told me, just because they can afford, based on their income and their debt structure, $1 million house,
Sure.
doesn't mean they want to buy $1 million house.
Or that they should.
Right. What's most important to me is what can they afford? What are they comfortable paying? Because I want them to have a quality of life. I still want them to go on vacations. I still want them to have a family. First-time home buyers a lot of times don't have a family yet, so they're going to have a family. There's going to be ballet shoes. There's going to be soccer balls to buy. There's diapers and all that kind of stuff. And the old saying is, you don't want to be house poor.
Yeah.
So it's very, very important for me to take a look at that and listen to what they have to say and structure a loan. And sometimes I'm the bad guy. They want to buy a $450,000 house or a $350,000 house, and based on their budget and their desires and the way they want to live their life, I say, no, you can't. This is what you can afford. And sometimes it's a hard conversation, but it's real. And if they go with you, driving around looking at a $400,000 house, and really they can afford a $350,000 or a $325,000, they're going to love the $400,000 house more.
Right.
But then they're going to not be comfortable short-term, long-term living in that house based on the payments and stuff like that.
Yeah.
So affordability is really specialized to each individual. There's not a blanket, what is affordable based on my income, what is affordable based on what I do. You have to take a look at it as an individual family and what we can do. And that's what I do.
So you'll get like a holistic view, because I know like, I think this happened also in like the 2008 crisis. People just get approved for a loan and they would be able to buy the They would say, you can buy this, and no one cared besides that. They didn't actually do any other due diligence. But so you're saying for you can approve them, right, on the debt ratio and what it could be. But then you'll have an additional conversation to say, okay, here's the number that you could afford. You know, like theoretically, and it's possible with the banking structure that I have. But let's talk about like if that is wise. You know, so then you'll have an additional conversation and say, okay, here's what is actually possible, but let's talk about reality. Okay, cool. Have you ever had anything happen where somebody, you know, wanted to buy something a lot more than what they really probably could have?
Often.
Okay, I figured,
when interest rates were historically low, unrealistic, if you look at history and you look at where we are today, people could buy more expensive homes and have payments that were more affordable. in the past 3 or 4 years, it's changed. People are figuring out, everything's online, so they can figure out principal and interest payments. You can look at taxes. Sometimes they underestimate the interest rate. Sometimes they don't put in PMI. If you're putting less than 20% down, there's private mortgage insurance that's needed, which we can talk about in a little bit. So they don't have the true facts of what their payment's going to be.
Sure.
And taxes online sometimes are different. Veterans don't pay taxes, so you may see very little. Or if they're over 65, they may pay very little. So if a first-time home buyer doing a little bit of research, not knowing certain specifics when they're looking up taxes, may have a smaller amount for their property taxes than what it is. And going forward, with houses appreciating, their taxes are going to go up.
Sure. That makes sense. Thanks so much for that. Let's talk about down payment.
Okay.
So I know for me, like I've had clients that have asked me, does it have to come out of my bank account? Can I receive a gift from like my parents? Or another big question is, are there any like down payment assistance programs? So maybe help us understand, does the down payment have to come from the people that are buying the home? And if not, where else could it come from? And then tell me about the down payment assistance programs and what do you think about those?
Okay, yeah. Ideally, you want the money in the bank.
Okay.
And a lot of people don't have that.
Sure.
Okay, so a gift can happen. A gift can happen from a family member, a mother, father, aunt, uncle, grandparents, brother, sister, whomever. It's a gift, non-repayable in our eyes.
Okay.
You can also look at your 401k. People go to their 401ks, and if you have one, you can borrow against it.
Cool.
And you pay a lower interest rate back to yourself. So you're not losing interest on what you've withdrawn, and you pay it back. There's no tax penalties because it's a loan. You're not withdrawing and getting penalized at 10% plus taxes. You're actually borrowing against it, and you're going to pay it back. So 401k is a great helper to get in there.
You can't take out a loan to buy a home, but you can take out a loan against yourself.
It's not a loan from somebody else. You're taking your money.
It's your money.
It's your money, right.
There's the difference.
And there are down payment assistance programs, and they're all different based on county, state, and what you're looking at. So Texas has the Texas Department of Housing and Community Affairs, where you can do a down payment assistance program.
Okay.
It is income driven, $117,000 to about $134,000, depending on the county you're in, depending on how many people are in your household. Would be equal to about a $580,000 sale price to be able to qualify for that. A lot of people in the Dallas-Fort Worth area as a household earn more than that, so a lot of people don't have the ability to do the down payment assistance program. We're going to take a look at that. We're going to take a look at the other programs available to them, conventional 3% financing, FHA, 3.5% down payments, and see if maybe they can have money elsewhere, 401k, a gift from a parent or whatever, to make their loan better than a down payment assistance program, because the interest rates can be higher because nothing's free.
Right.
Closing costs will probably be pretty similar and stuff like that. Some down payments assistance programs you have to pay back, so it's an additional debt to you. It just depends on what it is. So we need to make sure we're comparing. Your mortgage is part of your financial portfolio. So 401k, a loan, down payments assistance, how are you structuring it, how are you fitting it in within your family budget to do that. I have a client closing tomorrow.
Okay, congrats.
She's from Oklahoma, and she's part of the Chickasaw Nation.
Okay.
And they have offered her their program for their people, $5,000 grant for buying a primary, not a loan, straight money, buying a primary residence. And this young couple is buying in Arlington, Texas, not in Oklahoma. So they don't care. They're just taking care of their members or whatever their category is and stuff like that.
Yeah.
Primary residence, $5,000. Here you go, and they're closing tomorrow. And
and how much are they? Like, what is their total out of pocket for tomorrow?
It's going to be about $14,000.
And that's all in.
That's it, all in. Down payment, closing costs, prepaid.
Come on.
They have $5,000 from the grant, and the seller's paying the title policy. So on a $315,000 house, probably similar to my previous one I just talked about.
About 14.
14 grand walking in.
Love it.
Yeah.
Okay, let's shift gears to rates.
Okay.
Should I buy now, or should I wait for the rates to drop? What do you think?
Buy now.
Okay.
Hands down.
Okay. Why?
Yeah.
What? Why? Yeah.
So houses are appreciating on a modestly 1 to 3% each year.
Okay.
You know better than I do.
Sure,
so
sure.
you can pull out the numbers.
Yeah, yeah.
However, since 2018 and through the pandemic, it's 23, 30%, right? Increase in values and stuff like that. So you buy today, if you don't buy today, your $300,000 house, $400,000 house in 6 months or a year is a lot higher.
It might be 303, 306, 310.
You're losing equity every day. Our rates going down. If you look at the historical rates for a 12-year period from 2012 until 2022, beginning of 2023, those rates were unrealistic. The government was subsidizing the mortgage-backed securities, so the rates were really low. They bailed out the mortgage business in the 2010 area, and then the pandemic hit it, so they kept the subsidies going, so rates were at an all-time low. They started going up February of 23. And as you probably have known since you've been in the business, rates have not come down.
Right.
All the talking heads said when inflation comes down, rates come down. Well, inflation has come down over the past 3 years, but rates haven't come down substantially. Now they're talking about unemployment. When unemployment comes down, rates are going to go down. Rates have been coming down a little bit better. Then the war started 100 and some days ago, and oil prices shot up, and then inflationary scares happened, and so rates went back up. So rates aren't a driving force, but buy the house now to start building your real estate equity, assets, whatever you want to call it.
Yeah, to get in on it now.
To get in.
Yeah, that makes a lot of sense.
Yeah.
Because like I've had conversations with people that once I kind of let them know, because that homes are going to continue to appreciate, because like some person might want to put 3% down, right? And they're like, hey, I think I want to wait for the rates to come down next year. And I've kind of let them know two things. Okay, if you look at that same home next year, that home might be worth 3% more. So that 3% that you just saved just got knocked out.
Yep.
And so that doesn't really help you as much.
Right.
But then also, like if you're looking at actually the monthly payment of it, and you're looking at just comparatively like in the market, like if the rates drop, like if they went to 4% today, people, or 3%, if that happened right now, you might think that there's a buyer out there that's like, oh my gosh, like I can now finally afford a home.
Yeah.
But what I find that happens is that brings more demand into the market, because if you're thinking it right now and you're like, if rates went down today to 3%, I'm buying a house right now. Yeah. Think about how many other people there are that would have that same thought.
Correct.
So if you're looking at that home that's worth $415, but instead of having one person looking at it, you're having 23.
Yeah.
You're not going to be able to buy that home for $415.
Right.
You're going to have to go over asking, and then there's appraisal things that occur where you have to pay additional money out of pocket. So it's like, yes, the monthly payment could be lower, but that ultimately drives up demand, which drives up the price. And so the question is like, does it actually negate the monthly? And it's kind of hard to tell, but lower interest rate means more demand, which means higher price. Higher interest rate, lower demand, lower price.
Right.
So it's kind of pick your battle.
Basic economics from high school, which was a long time for me, pretty recent for you.
Yeah.
Supply and demand. If there's a big demand, prices go up. And we saw it during the pandemic. Interest rates were really, really low. Everybody wanted to buy a house. People are overbidding. People were getting outbid, 10, 20% higher than the list price.
Right.
You're right.
Yeah, I mean, it was
wild.
Prices,
first-time home buyers. So buy now. The interest rates are still good. And if the interest rates go down, you win.
Right.
If you don't go down, you win because your house is still appreciating and you have a home.
Yeah. You win either way is what I'm hearing.
Yep.
So we mentioned a little bit earlier about PMI.
Yeah.
So help me understand, what is PMI and like why should I care about it?
PMI is private mortgage insurance.
Okay.
Lenders require PMI if you put less than 20% down on a conventional loan.
On a conventional
loan.
On a
conventional loan.
Okay.
There is PMI, I'm going to use it loosely, on FHA, and there is none on VA. Okay. So if you're putting less than 20% down, you're a greater risk to the lender. If you default on your loan, the PMI company has insured the loan where they're going to pay back a certain percentage of the loan, so we don't lose as much money going through a foreclosure proceeding.
Okay, I see.
Okay? We have figured out in the business, so I've been told, that if you're at an 80% loan to value or less, it's basically a break-even point in a foreclosure proceeding, depending on the time frame.
Okay.
Okay? So we want to insure our loan.
Your money back.
Our money back.
Yeah.
Yeah. So we require mortgage insurance.
That makes sense.
somebody uses the word, everybody hates PMI. It's not as bad as it used to be. PMI premiums are based on the supply and demand, so to speak. So back in 2008, 9, and 10, when the real estate industry was blowing up, lots of foreclosures. So PMI companies were taking it a bath. As with homeowners insurance, with all the national disasters going on in Florida and around the country, fires, they're taking a bath, so premiums go up. So PMI got pretty expensive for a while. So it had no benefit to a buyer because it's protecting the lender, but it was expensive.
Okay. What does that mean, expensive? Like how much per month? Does it depend on the loan?
It depends on the loan, depends on the loan to value, depends on your credit score. It's all a premium and everything like that. And I have an example in just a second.
Okay, yeah, sure.
Yeah. As foreclosures declined, mortgage insurance companies then had to compete against each other.
Oh, okay.
So now there's competition. So I lower my premium because I need business, and then I lower my premium, and so the premiums have come down quite a bit. So is PMI an evil thing? Not necessarily. Let's take a look at a $400,000 loan, sale price.
Okay, sale price.
20% down.
Okay.
$80,000, no PMI. Okay. So that's your investment plus the closing costs, and we'll get into that.
Yep.
Or put 10% down, $40,000. Okay. The PMI would be $54 a month on a 90% loan to value, $650 a year.
Okay.
Not
sure
a backbreaker or anything like that. But you keep $40,000 in your pocket. What do you do with that $40,000? You fix the house to make it more beautiful and shiny and valuable. So you're building appreciation in that. Do you pay off credit card debt? You pay off a $20,000 credit card, it's going to be more than $54 a month. Plus, an interest rate on a credit card is a lot higher. Do you pay off your car? Do you save it for a rainy day? You're going to have a family in the future, so you want to have monies for medical expenses or just life in general. Or it's peace of mind having $40,000 sitting in the bank and it's costing you $54 a month.
Yeah.
And you put $40,000 in the bank earning 5%, you're making $2,000 a year on it.
You make more than what the PMI
would have been. So you make more than the PMI would be. So you're
Yeah.
still netting $1,400 a year by not putting the extra $40,000 down. So PMI is not as evil as you think. You just, again, your mortgage is part of your financial portfolio.
Yeah.
You got to put it all together. And I try to educate my borrowers on that. I don't want to pay PMI. Well, let's talk about that. I'm not trying to sell them on anything.
Yeah.
I'm just educating.
Right.
know?
It's just like what actually makes sense for your family.
Yeah.
If you want, like a lot of people do pay PMI, but it could be something that actually isn't that big of a deal.
Yeah.
Cool.
PMI also goes away. So as your house appreciates and as you pay your loan down, PMI can go away. You just have to call your lender and say, how do I get rid of PMI? And they'll walk you through it. On a typical 30-year loan, PMI, if you're not doing anything special and just appreciation and just paying the loan down, PMI can go away in 6 to 10 years automatically and just drops.
Oh, interesting.
Yeah. Where on FHA, it never drops.
Okay.
So,
how about that?
So you take a look at 3% down compared to 3.5% on FHA and conventional, the PMI, and you do all the calculations. What's the best loan for you? It just depends.
Go. Cool.
Yeah.
Ken, this has been awesome. Thank you so much for all the clarity that you've given thus far.
Yeah.
Basically, final question right now is that for someone who is watching this and they're maybe scared or they don't really know what to do, but maybe say where they're scared about actually buying a home. What would you actually tell them? What advice would you give that person?
I would tell you to have them call me.
Okay. Hey, there you go. That's fair.
Step one.
Yep.
And then I would encourage them to sit down with me face to face, not over a telephone or a Zoom or emails. Sit down face to face at a coffee shop, at a restaurant, at their apartment, their parents' home, my office if you want to come out to the South Lake area. With time, not a lunch break where you have to get back to work real quickly, not at a time frame where you have limited time. Budget an hour and a half because sometimes I can get chatty.
Yeah, sure.
But there's a lot to talk about. It's the biggest purchase of their life.
Yeah.
And let's just talk about buying a house and why they're scared, and let's talk about the numbers. Again, I ask a lot of questions, and we know about their budget, and we can share information. We can take a look at their credit, and we can talk about if anything needs to be done or if anything doesn't have to be done. I would just sit down with me, talk through it, and I can almost guarantee by the time we're done, they'll be ready to buy a house sooner than later, and the stress will be eliminated. I had a young couple last fall come to see me. They said, I've talked to another lender a year ago, and they scared me, and they say my credit's not good, and this and that. So I said, let's just sit down in my office. We sat there for about an hour, hour and a half. I did a soft credit pull. I got all their information. We were just talking. They said, we don't have any money right now, but we're saving, and we're hoping to buy a house in the next 6 to 8 months. I said, and then I was looking at their information. I said, you used to work at a hospital in Houston. Did you have a 401k there? And she's like, yeah, I did. I forgot all about that. I said, how much do you have in that 401k? She goes, oh, about $20,000. I'm like, why don't you call your financial advisor? Why don't you see if you can withdraw that money? And even if you have to pay penalties on it and taxes on it, you could buy a house today because your credit is good enough today to do an FHA loan, get a great interest rate, and you can buy a house. This was in November we talked.
November 25?
November 25.
Okay.
We talked, and she's like,
yeah,
light bulbs.
Yeah.
She called her uncle, who's her financial planner. She called the servicing company over 401k, and they say, absolutely, you can do whatever you want to do. Since you're buying a primary residence, it's not an early penalty on it based on their program and their guidelines.
Yeah.
And they bought a house in February. Unfortunately, not with me. They bought in Denton with a builder, and the builder threw out thousands of dollars in incentives.
Yeah.
But they bought a house thinking they weren't going to buy a house for another 6 to 8 months or longer in November, and they closed and moved in with their 2 young children in February.
Come on.
Yeah.
How about that?
So call me.
Call Ken. The answer is, if you don't know where to start, call Ken. Well, Ken, thank you so much for your time. I so appreciate you.
Yeah.
If you guys do want to get a hold of Kent, there's going to be a link in the description below that you can check and see and learn more about Kent and get a hold of him.
Yeah.
Really appreciate your time, Ken.
Thank you.
Thank you all. Have a good rest of your day.